What's up guys, Jake here. I lost a lot of money. However, I did it for you guys. I did it for the viewers. And in this video, let's cover exactly what I did, why I did it, and what we can learn from it. On my channel this year, I'm experimenting with lots of different kinds of investing strategies, and one of them that I wanted to explore for you guys was the dividend capture strategy. Now, at the beginning of the month, I made this video, the dividend capture strategy, bad idea. Then mid-month, I did an update talking about my progress. This video is the third video in this mini-series about the dividend capture strategy. And what it is, if you haven't seen these videos, is you jump in and out of dividend-paying stocks to capture their dividend payouts. So how this works, the day before an ex-dividend date, you need to buy that stock. Then, if you're holding that stock on the morning of the ex-dividend date, you are the person, when the shares are recorded 2 days later, who will receive the dividend payment from the company. So on the ex-dividend date, you can sell your stock and then jump into the next dividend-paying stock. And you can do this almost every trading day of the year. If you just search for dividend-paying stocks or ETFs, you're capable of jumping in and out of one of these stocks every trading day of the year. So, is this a good strategy? That's what I wanted to explore for you guys with this three-part series. And the results are in, and no, it wasn't. For you guys, I put $25,000 in my Robinhood account, and then I did this. Every day for the month of July, I was jumping in and out of ex-dividend paying stocks. And this is widely reported about this strategy that it doesn't work because the value of the company is going to adjust for its dividend payout. When a dividend payout is known, this is public knowledge, when it's happening, how much it's happening. And for large institutions that trade these stocks, they factor that into the share price. So the share price will reflect this dividend payout on the ex-dividend date. Now my account is currently at $21,937, down 11%. However, I still have dividend payments coming. It takes, once again, a couple weeks after the ex-dividend date before you receive a payment. So I haven't lost this much, but I did lose this much. Here is my Excel sheet tracker for the entire month, and I net lost $1,510. For the month of July, there were 21 trading days, and I picked a different stock to jump in and out of each day. There was one day where I couldn't get to my computer, so I couldn't trade, so I did miss a day. So there were 20 dividend-paying stocks that I did jump in and out of every day of the month. And when you look at what the dividend yield of these companies is, divided by 4 if they're quarterly dividends, I should have made about 12% of my money this month if the share price of the company doesn't drop exactly by what the dividend payout was. So this is the dividend per share payment. This is how many shares I purchased. I was trying to purchase about 24,000 each time I swung in and out. So this is how much I made in dividends. And I guess we can just quickly sum this. Let's do some, let's see here, G2 through G22. Okay, so I did receive $2,636 in dividend payments for this challenge. However, how much did I lose in stocks? And we can just carry this over. And I lost $4,000 on the sales. So I had to purchase the stock and then the next day sell it. And this is what I made or lost on the sale of the stock. So if this had kept neutral at 0, then yes, 2,600 is about 12% of 25,000. So if the share price of the company doesn't drop by what the dividend payout is, then this would have worked, but it doesn't work. And to understand the results of this experiment, we have to compare it against something. So what we can compare it against is the S&P 500. If I had just bought and held an S&P 500 index ETF like State Street's SPY, how would I have done? And for the month of July, I would have been up 2.44%. But instead, I'm down, let's see, you know, I'm down probably around 6 or 7% from my $25,000 starting balance. Now, one of the biggest risks of doing this strategy is you are all in on a single stock each day. And if something happens with that individual stock that day, which just happens to be the ex-dividend date, you're in trouble. And this is kind of what happened for me on 2 different days. On July 19th, I was holding Caterpillar stock, and it went down pretty significantly. And then on July 29th, I was holding a company named EPR. And if we look at their share prices, you can see what happened here with Caterpillar. The S&P 500 dropped this day. This was July 19th. However, because Caterpillar is more of an industrial cyclical stock, this fell harder than the S&P 500 that day. And I just happened to be in an industrial stock on the day that the entire market was down. As for this company, EPR Properties, I don't know, it's in a slump and it's down 7% over the last week. I just happened to jump in it when it was downtrending for whatever reason. I don't know anything about this stock, another disadvantage to this strategy. I just jumped into it because it had a 3% dividend yield. So final results is I don't recommend this, guys. I wanted to use a significant amount of money to basically dramatize the results, but I did lose $1,500 doing this. Now, I know in the comments section there are people who do this strategy and they swear that it works, that I am doing it wrong, that if I had just jumped into different stocks or specific ETFs, then this is easy money, every day collecting dividends. However, I hate to be the one to tell you there is no Santa Claus, but dividends don't really matter. Now, the long-term buy and hold return of an S&P 500 index fund is about 10% a year. So, if you're buying dividend stocks or jumping in and out of dividend stocks and you're not beating that annual return of 10% a year, then there's an opportunity cost there, and you could have made more just buying and holding an index fund long term. We can look at a specific example. This is Vanguard's Admiral shares for their S&P 500. The ETF equivalent is VOO. And yes, this index is very volatile. Some years it's down 36%, but some years it's up 32 or up 21 or up 31. But the long-term average over 100 years worth of data is close to 10%. Does that mean next year we're going to get 10%? No, it could be negative next year. It could be negative the next 3 to 5 years. But if you buy and hold long term, you're set up for success. And when we think about dividends, dividends are really irrelevant. They're not important. I actually do value dividends a little bit because it shows maturity from the company that they're so well established that they want to start paying a dividend to their shareholders, but it doesn't improve the value of the stock at all. When you look at the total return on your investment in a year, it comes from either dividend payouts or capital appreciation, the share price of the company increasing in a year. And it doesn't matter how you slice it, with the company paying you a good dividend rate or the share price of the company going up in the year. You can only gain value from the stock by one of two ways. And I know people who love dividend stocks say that dividend stocks are so great because you're earning passive income without having to sell shares. But this really is irrelevant. Dividend-paying stocks are basically the equivalent of a company that doesn't pay out dividends. They're forcing you to sell stock. And I'll explain it this way. Let's pretend we have two identical companies, let's say they're parallel dimensions, and you were to invest $100,000 into each of these companies. However, one company pays a 10% dividend, the other one doesn't pay a dividend at all, and both companies in a year appreciated by 20%. Now, if you were in the dividend-paying stock, they're going to pay you out 10% after the company appreciates to $120,000. So your stock in capital appreciation, after capital appreciation, is worth $108,000 and you were paid out $12,000 in dividends. But the company that doesn't pay a dividend, your stock is now just worth $120,000. If you want to pay yourself in passive income, you can just sell 10% of the stock. That will give you a $12,000 payday today. The problem with dividends is the company is forcing you to basically divest from the capital of the company. And this is a taxable event. If you are paid this $12,000 this year, you've got to pay the qualified dividend tax rate of 15%. Whereas with this stock, if you're thinking a stock that doesn't pay a dividend like Amazon or Facebook or Google, it's just going to keep going up higher, faster. Dividends slow down the value of the share price of the company. And this is really obvious when you just look at classical dividend stocks. For example, Coca-Cola has a dividend yield of 2.95%. And what has their share price done the last 5 years? It's barely gone up from 45 to 57. It's up 31% in 5 years, but that is far below what you would have gotten had you just been investing in an S&P 500 index fund. Same thing with Verizon stock. The dividend yield is 4.5%. That's a pretty good dividend yield rate, but look at the share price of the company. It's only gone up 4% net in 5 years. If you had held Verizon instead of an S&P 500 index fund, you would have been vastly underperforming the market. Terribly, terribly underperforming. However, the counter argument to that is that dividend stocks basically pay better than bonds, they pay better than US Treasuries, and they hold their value when an economic downturn occurs. Like, look at this chart, where did the flash crash for the pandemic occur? It happened right here, but it doesn't even seem noticeable because once again, people buy this stock for the 4.5% yield on the dividend. And there are definitely high growth stocks like Apple that still pay a dividend, the dividend yield of 0.6%. Now, this stock is up 442% in 5 years. Apple has greatly outperformed the S&P 500 index fund. However, if Apple wasn't paying this dividend, then the share price of the company over the last 5 years would be much higher. If you want to then sell shares to pay yourself passive income, that's the equivalent of being forced this distribution of 0.6%. Now, if you're a mature company that you don't think there's tremendous growth left to you, then yeah, sure, pay a dividend. But a better option for investors is to buy back stock. If you have surplus cash and you're a company and you want to reward investors, then do stock buybacks. Don't pay dividends. Dividends are taxable events, but stock buybacks for shareholders don't result in you having to pay any more taxes that year. So when we think about the long-term average of the market, of an S&P 500 index fund being about 10% a year, you have to get there. You have to get there from dividends being paid out and capital appreciation of the stock, the growth of the stock. This is something about individual stock picking that I've never understood, why people buy stocks that pay high dividends but still underperform a total stock market or S&P 500 index fund. Dividends are irrelevant. Dividends don't help you in the long run if you're underperforming the market. So what is the main takeaway from this challenge that I wanted to share with you guys? And it's paradoxically, when is the best time to buy a stock if it pays a dividend? And it's after the ex-dividend date. You don't want that dividend. The share price of the company factors it in. So if you get in before an ex-dividend date, then you'll collect a dividend, you'll have to pay taxes on it. But if you just wait until the dividend distribution is made and then buy the stock, it's already factored in. The share price is dropped by the equivalent amount, and this way you don't have to pay taxes. So really ironically, the best time to buy a dividend stock is after the ex-dividend date to avoid the dividend. The dividend is tax inefficient and just slows you down. Okay guys, I hope you enjoyed this channel. Don't feel bad about me losing that $1,500. I promise you I will get it back from trading options. I've got more videos coming for you soon about vertical spreads. A lot to learn here, a lot to unpack. I'm having a lot of fun with them. Check out those videos. If you enjoyed this challenge, give me a thumbs up so the algorithm knows it's good. If you have any comments or questions or want to argue with me about how great dividends are, let me know down below. I love hearing from you guys. Till the next video, take care.